So you're seeing the headlines that inflation is finally cooling off. And you're probably thinking, great, my mortgage rate should be dropping any day now, right? Well, it's not quite that simple. The reality is actually a lot more complicated. Let's dig into why those rates are being so stubborn and, what it all means for you.
I mean, this is the big question, isn't it? It's the paradox that's got so many potential home buyers just scratching their heads. All the signs, they seem to be pointing towards some relief, but the numbers, they just aren't budging. So over the next few minutes, we're going to unpack exactly what is going on behind the scenes.
Okay, so look at this. This really puts the whole contradiction in a nutshell. On one hand, you've got the good news. A super important inflation measure finally went down. Awesome. But then, on the other hand, the frustrating news for anyone looking to buy a home, mortgage rates didn't just stay flat, they actually ticked up. How on earth does that make any sense?
All right, let's solve this thing. To really get to the bottom of this mystery, we have to start with that piece of good news, the thing that got everybody's hopes up in the first place. And it all comes down to one really key economic indicator. And that indicator is something called the PCE Price Index. Now, I know you probably hear a lot more about the CPI in the news, but listen, the PCE, that's the one the Federal Reserve really cares about. When the folks at the Fed get together in a room to decide what to do with interest rates, this is the number they're all staring at. It's their go-to metric. So this chart here really shows the journey we've been on. Just look at that peak back in September of 2022. We're talking over 5.5%. Yikes. Then it fell, and it fell dramatically, hitting a low just this past April. Now, yeah, okay, this latest number for September shows a tiny little uptick to 2.82%, but the big picture, the overall trend, it's clearly heading down, getting closer to the Fed's 2% target. And that is the positive signal the market was seeing.
So you see inflation cooling off, and you think, okay, the Fed's got to react to this, right? Well, the market sure thought so.
And here's the proof. You can think of financial markets as these giant betting pools, where people are placing bets on what the Fed is going to do next. And they were pricing in an absolutely overwhelming 87% chance of a rate cut on December 10th. The expectation couldn't have been more clear.
And this is where things get interesting, because this is a crucial point. I mean, textbook Economics 101 tells us that when the Fed cuts rates, borrowing is supposed to get cheaper. For everything. We're talking credit cards, car loans, and yeah, especially mortgages. So why didn't it happen this time?
Okay, to find the real answer, we've got to look past the headlines. We need to dig into what the big money investors, the people who are actually setting these mortgage rates, what they're really seeing.
And here it is, the first huge piece of the puzzle. For these investors, that good inflation report, it wasn't news, not really. They had already seen it coming, they anticipated it, and they had already made their moves. It's a concept called pricing it in. So when the official announcement came out, it just confirmed what they already knew. There was no surprise, so there was no reason for a big, sudden drop in rates.
See, instead of reacting to what they consider old news, these investors are playing chess. They're looking way ahead. And as this quote from Pantheon Macroeconomics points out, they see some potential trouble brewing on the horizon. They're getting a little worried about the underlying health of the economy.
So what are they worried about exactly? Well, for starters, they're seeing signs of a weaker labor market. They're also seeing really sluggish income growth. I mean, take-home pay was up just 0.4%. But there's another really big factor that's making them nervous, a kind of outside force that's artificially pushing prices higher, and that's tariffs.
Yeah, this whole tariff issue is a huge curveball in the inflation story. And you can bet that investors are watching it like a hawk.
And just to make this super real for a second, economists over at Yale estimate that these tariffs are costing the average American household about $1,700 a year. So this isn't some abstract economic theory, right? It's a real cost that gets passed right along to you and me, keeping prices higher than they should be.
And this chart right here shows you the direct impact. Look at that. The official core inflation number was 2.82%. But if you strip out the effect of the tariffs, well, according to Pantheon Macroeconomics, that number plummets down to 2.4%. That is a huge difference. It really shows you how much this one single issue is propping up inflation.
And just to add another layer to the drama, the Supreme Court is actually expected to rule on whether these tariffs are even legal this month. This creates this giant cloud of uncertainty. And if there's one thing that investors absolutely hate, it's uncertainty.
Okay, so with all this complexity, all these moving parts, where are things headed? Is there any good news for home buyers out there on the horizon?
Well, yes, actually there is a glimmer of hope.
and we can find it in something called the 30-10 spread. The easiest way to think about it is like a fear gauge for mortgages. It's basically the gap between the 30-year mortgage rate and the rate on the super safe 10-year Treasury bond. And the wider that gap gets, the more nervous lenders are feeling.
And here's the good news. After stretching out to some pretty painful levels, that spread, that fear gauge, is finally starting to shrink. It's getting closer to its normal historical average. And what that suggests is that some of that fear is starting to leave the market. And that is a very positive sign for future mortgage rates.
But, and there's always a but, isn't there? Even with that positive sign, the experts are totally split on what happens next. You've got two of the biggest players in the mortgage world, and they have completely different predictions for 2026. Fannie Mae, they're thinking rates will drop below 6%. But the Mortgage Bankers Association, they're predicting a higher average, around 6.4%. So yeah, no consensus there at all.
So where does all this leave you? Well, we've got inflation that's cooling off, for sure. But it's in this tug of war with nervous investors, these hidden pressures from tariffs, and just this huge cloud of uncertainty hanging over everything. So the real question now isn't just if mortgage rates will fall, but what is it going to take? What's the final piece of the puzzle that finally makes it happen? And that's the answer everyone is waiting for.